Hey everyone, I'm Dave Keller, the Chief Market Strategist at StockCharts.com. Welcome to our YouTube live Q&A on a volatile Thursday morning here in February. It's all about market volatility, all about uncertainty, the VIX, the fear gauge spiking up. So what does that mean for the big picture and what we're doing? The goal with the live Q&A here on YouTube is to answer some of your questions. So got a couple charts I'm going to go through very quickly. And then any questions you have, just put them in the chat room, and we'll get to them right at the end. So let's get to it. So looking at the markets, the S&P obviously down, but most of that came right at the beginning, and since then we've sort of had this stepwise motion back higher. And again, the daily chart of the S&P actually doesn't look as bad as it did first thing this morning. It looked like another huge gap down, another further sell-off. Since then, though, we've rebounded a little bit, and the level I've been looking at, sort of that line in the sand, is this confluence of support, which is the 200-day moving average, the low from December, and the 61.8% level. All of those are around the 30.50 to 30.70 range. We are right in the heat of that. We traded much below that, but now are closing right sort of at the upper end of that range. So I think on a closing basis, we're right about where you'd expect a pullback to subside, right? It's sort of, if this is a garden variety, short-term sell-off, digesting the gains, profit-taking before we, sort of resume an uptrend, we're kind of there. We're kind of at that point. So the question now that I think remains to be answered through this week is, do those levels hold? Is this the time at which, we bottom out, we start to back and fill in this area before we resume a higher move, or do we close below it? And again, looking at where we're at on a closing basis below some of those key levels would be key. So trading below it and closing back above it is actually pretty decent. That's actually holding up pretty nicely. So it'd be interesting to see how that plays out. Thinking about sentiment, one of the things I'd look at is the AAII ratings. That's the weekly survey of individual investors. What's interesting is this week, sorry to shoot around a lot, but what's interesting this week is as the market sold off, much less bulls than last week, so we're down a decent amount, but not horribly bad. Almost 1 in 3 respondents still pretty constructive on the market. So more bears than bulls, which is different than what we've had the last couple months actually. But still 30% of respondents pretty constructive. So not as negative as you might have thought. If you think about volatility, you think about extremes in uncertainty. I think of the VIX. And that's this chart right here. I was talking with one of my colleagues right before we started, and he said, it's because the VIX if the VIX gets above 30, does that mean we bottomed out? And I had the same question back here when the VIX hit 20. So I said, all right, the VIX gets above 20, does that mean we're bottoming out? And unfortunately, no. Remember, the VIX is not upwardly bounded, really, to be honest with you. It can go much higher. And that's what, this level of around 25 seemed extreme until December when we got into the mid-30s. So, we are now in the level at which previous sell-offs have sort of capitulated, but the VIX hitting a certain level for me has never really meant a ton because it can go way further than you'd expect. So an extreme level doesn't, there's no line in the sand in my opinion on the VIX, but knowing that it's at the extreme ranges where we've started a bottoming process is interesting. But I'm going to want to look at the price itself and make my own decision as to where things are going. The last chart I just wanted to highlight real quick. We talked about this on the final bar yesterday, which is our closing bell show after the close every day here on StockCharts TV. And one of the charts we looked at was the S&P and then the percent of S&P names above their 200-day moving average, the percent of S&P names above their 50-day moving average. What's interesting is 4 out of 5 S&P stocks now below their 50-day, and that's actually broken below the levels that we saw last spring and last summer. These were on the pullbacks that we had here in May to June, again in August, again in October. So we've now broken below there. So enough stocks have actually broken down through the 50-day that this feels more like some of the deeper corrections, maybe back here in 2015 or maybe the beginning of 2018, end of 2018. So, it's lining up with more of a severe pullback so far. The real key line on the sand on this chart, the reason why I think it's interesting, is looking at the 50% level. If you look back at the last 5 years, in this, and obviously this has been a consistent uptrend, pullbacks that have rebounded or that have hit around the 50% level. That's what happened a couple times last year. Also happened there in the first and second quarter of 2018. The percent of stocks remained above 50, the percent of stocks above their 200-day moving average. So most S&P names remained above their 200-day moving average. That suggested that it was less of a painful decline. It was more of a pullback within a longer term uptrend. When it gets below 50%, then it starts to look like mid 2015, starts to look like the end of 2019, and potentially starts to look like where we're at now. So, again, I think we're at a really key point here. A lot of stocks have sold out very quickly. Do they hold the 200-day? This chart right here is going to tell me whether or not it's a short-term pullback or whether it's a deeper correction, what's most likely. So those are some of the charts that I'm thinking about. You guys send some questions, which I'd love to get to right now. If you have other questions, just shoot them in the chat real quick. We'll get to them right now. Do you recommend zero coupon bond funds or VIX as a hedge in the current market environment? Any other ideas? So I can't formally recommend anything, but I'll certainly make some suggestions about how you could think about it. And thanks for the question. The question is, when everything sort of goes down, what do you do? And what's so funny is not too long ago, we had the opposite problem, which was everything's going up. So what do you do? Where's the, what's different, right? So a couple weeks ago, even a week ago, everything was in an uptrend, right? Stocks, oil, gold, bonds, dollar, all sort of going up. What happens now? So now we've had this sort of disconnection, which makes sense. That's an unsustainable pattern when everything's going up. Now we're starting to see some things fan out where certain things underperforming, stocks certainly coming off dramatically, oil coming off dramatically, the dollar weakening very significantly. So what's working? It's two things right now. It's bonds and it's gold. The rest of commodities holding off dramatically, but gold holding off okay. And so, if I'm looking for places to diversify, hopefully you've diversified before this moment. But if you haven't, those are some of the places that I would be looking. And I think, thinking of the chart of gold stocks, if you're going to be in equities, gold stocks are pretty fair. I mean, this chart of the GLD has held up very well. This is not gold stocks. This is holding physical gold. But even with some spikes, with some pullbacks, it's still in a pretty good primary uptrend, higher highs, higher lows. That 152.50 level is the level in the short term that I would want to hope it stays above. But overall, the RSI is in a bullish range. Overall, it's outperforming, and I think there's much more upside. If you look longer term at the chart of gold, it looks pretty constructive, and people would certainly start to move there as a safe haven. And then, as you suggested, things that give you exposure to fixed income, I think, are very compelling right here. This is a chart of the TLT, which is a good proxy for just overall bond prices. It's looking at the long bond, the longer end of the Treasury curve, and you can see it's been a very constructive pattern breaking to new highs in a good uptrend, overbought, but that's okay. It becomes overbought here at the beginning of December of 2018 before much further upside. So I think looking at gold, looking at bonds, and different ways to get exposure there, I think is a really good bet. The VIX I tend to avoid as an investment vehicle. I don't tend to think of it that way. I like to think of it more as a read on sentiment. So that's what I would suggest. Thanks for the question. Second one, how far back would you look when comparing present levels to prior levels? Which levels should you consider or disregard? That's such a great question. And I'll look at a chart of the VIX for that. And there are so many ways to answer that. To be honest with you, the further left that you go on the chart, the more and more disconnected you are to the current price. Here's a chart of the VIX. If we're looking back at the last 2 years, I've sort of framed out this time frame that I'm using. And if you go much further, all of a sudden you're getting into a very different picture, right? So if you're comparing right now to 20 years ago on any chart, I don't know how meaningful specific levels are going to be, because that's a completely different cohort of investors that are even investing at that time. Most investors trading now weren't really investing, or it's certainly a different group of people than it was there. So I would say the further you go back, the more and more irrelevant some of those levels are. But what is very relevant is seeing where we're at relative to key levels. So if I go back like 20 years on the VIX, for example, now we're starting to see, even though the levels right now look at extreme, look back at when we were in a really painful market environment, the VIX can go way higher. And that's what I would sort of remind you is this is where I think charts have value as a long-term historical reference. Most of the charts we're looking at have been done, or we're looking at this environment, which is a raging bull market. It's a cyclical bull within a secular bull, arguably. If we would, enter into a different environment, we have to look back at some of these previous periods. You have to look at the 2007 to 2009 period, look at the 2015 to 16 period, look back at 2003 or something like that, and see what happens when we're in more of a secular bear phase. And again, I'm not saying we're definitely going to get there, but it will help you to see how charts can look dramatically different, and you're not going to be prepared for that if you're just looking at the recent price. So that's my quick answer: is the further to the left you go, the less and less meaningful specific levels are, unless you're doing a historical reference at a different period. Great question there. Thank you. And thanks for getting these questions in. These are fantastic. Any good resources to learn more about Fibonacci numbers? You were asking a question that I have a very biased answer, which would be our Chart School pages. If you go to the Chart School, look for Fibonacci, you'll find some great comments on there. Where have I learned the most about Fibonacci retracements? I first learned them actually as a musician, but reading John Murphy's book, Technical Analysis of the Financial Markets, was probably the greatest way that I learned about just the basic way to apply them. I would also tell you, if you want to get deeper than what John does, Bob Prechter's book that he wrote with A.J. Frost, which really talks about Elliott wave theory, which is not a main part of my toolkit, but his discussion of Fibonacci relationships and what they mean. I learned a lot from going through some of his work, and other analysts and practices like Elliott wave and Gann go way deeper into Fibonacci than I tend to go. I tend to use them as a basic frame of reference, especially on pullbacks, and I think it's really helpful right now. That's why I'm using it on chart of the S&P. How far back do you look at $PSX? I'm assuming you mean the SPX, but I'm going to look at that real quick to see if I'm missing something. Yep, you're looking at the SPX. That's no problem. So the question was, how far back do you look at the S&P to fill gaps? I get what you're saying. So we're gapping down. Where do you look back there? So again, I think looking most recently when this happens, the problem we've had on a chart of the S&P and with many stocks is we've been in uncharted territory. We've been going further and further up and to the right, long and strong, and as a result, you don't have somewhere to the left to look back to. Where Fibonacci retracements can really be helpful, and support and resistance levels, it's all based on where we're at relative to where we've been. So when we sell off, you've got a lot of really good frames of reference that we can use, and these levels have memory. So if you look back at the low from December, we all remember that because we were all hopefully buying there. We knew when the market pulled back what that felt like. If you go further back, I think you're getting into levels that are not as meaningful to us. So in general, when we've had a big run and then a pullback, you want to look back during that big run as the key levels to pay attention to, and that's the answer I would give to you there. Everyone, thanks so much for all of your questions. I appreciate it. We'll do this every Thursday morning, 1:30 p.m. Eastern, 10:30 a.m. Pacific. Join us next Thursday, and we'll answer your questions then. Also, the final bar is every weekday, 4 p.m. Eastern on StockCharts TV. Go to our website, StockCharts.com. You'll see us there. This is Dave Keller from Redmond, Washington. Have a great day, everyone. Hang in there.